Step 3, manage risks around holding a large concentrated position. This is a big one, especially for tech professionals. If you've received RSUs, stock options, or participate in an ESPP, chances are a big chunk of your net worth is tied to your company's stock. And while it might feel exciting to see that number grow, it also introduces what we call concentration risk. Here's what that means. Your income, your job, and your investments are all tied to the same company. So if something goes wrong with the company, you're impacted in multiple ways at once. That's a lot of risk sitting in one place. I once knew someone who had over 70% of their investable assets in one company stock. The company was doing great until it wasn't. A product delay and some negative press caused the stock to drop nearly 40% in just a few months. That client's portfolio took a big hit, and they were left wishing they had diversified sooner. So what do we do about this? At TrueRoot, we walk clients through what we call a gap analysis. We look at your full financial plan, and then we temporarily remove your company stock from the equation. We ask, can you still hit your goals without it? If the answer is no, then we know that some of that stock needs to be sold and diversified. Now, I know it's not always emotionally easy to sell. Maybe the stock has performed well. Maybe you believe in the company, or maybe you're holding out for a higher price. But part of smart financial planning is asking, what happens if I'm wrong? And how do I protect myself just in case? Imagine your company's stock is like a golden goose. It's been laying golden eggs for a while. But what happens if one day it stops laying? Wouldn't it be smart to sell a few eggs along the way instead of counting on that goose forever? Diversifying doesn't mean you don't believe in your company. It means you believe in your future. And for clients at private companies, there's often another layer. You may be given the opportunity to sell shares in a tender offer. That decision can feel complicated. Should I sell? How much? What about taxes? We help you run the numbers and evaluate the trade-offs. One client at a late-stage startup had the opportunity to sell shares at $20 per share. They weren't sure whether to take it. We walked them through a scenario analysis, how their future would look if the company IPO'd at $30, stayed at $20, or dropped to $10. In the end, they chose to sell half. That gave them cash for a down payment on a home, and they still held on to some upside if the company continued to grow. Bottom line, you don't want a single point of failure in your financial life. We work with clients to gradually sell and diversify over time in ways that are tax efficient and emotionally manageable. Remember, wealth that's concentrated can grow fast, but wealth that's diversified tends to last.